Traders and long-term investors use technical, fundamental, and sentimental analysis to identify entry and exit positions. They do this with a view of entering and exiting the trades at the right time. Unfortunately, there is no definitive system that can accurately tell a trader when to enter or leave a trade. This is simply because the market is controlled by people who have different ways of reacting to their emotions. There are many tools that can help you in your daily activity of trader. One of the most popular and used are undoubtedly the Bollinger Bands. Bollinger Bands have become important trend indicators, so traders use them to identify a market that is trending. This tool was developed by John Bollinger in the 80s. Today, they have become some of the most common indicators in the industry. Traders use them to identify a trend by checking overbought and oversold positions. The concept of Bollinger Bands come from standard deviation, which is a statistical calculation or unit that measures the dispersal pattern of any data. It includes about 68% of all data points for the normal distribution pattern. Two standard deviations include roughly 95% of all the data points. How to calculate? The calculations behind the Bollinger Bands concept are really long and traders used to calculate them in the past. Today, this has changed with the introduction of automated trading. As such, one needs not to understand the background but the concept behind it. In fact, only a very few traders have the knowledge about the mathematical background of the bands. Here's how bands are calculated. The first step in calculating Bollinger Bands is to find the simple moving average of the asset in a certain period. The most popular period is 20 days. You can easily tweak that to match your trading strategy. The next step is to find the two standard deviations of this simple moving average. You can calculate the upper band as move 20 plus 2 times 20 standard deviation of close. Also, you can calculate the lower band as move 22 times 20 standard deviation of close. The chart below shows how Bollinger Bands look like in a real trading chart. When using the Bollinger Bands, the area between the moving average, MA, line and each band is known as the OR channel. The OR channel is important because it produces a range. The MA line is the middle line. In addition, the area between the moving average line and the above line is the buying channel. The buying channel. It is a buying channel because the spot rates displayed have a higher moving average which